Yeah, hi there. It's been another good week in the stock market. So, last week we mentioned that the Fed is poised to blink. So we got the blink on Wednesday. So Powell indicated that that they would be accommodative in terms of monetary policy. That was widely expected. So the market had another very nice week, up about 2.3%. So it's interesting. The S&P 500 is now exactly where it was at the high on May 1st at about 2954. That's actually slightly higher than the October high, which is quite important. So the pessimists at this point who are saying that there's a lot of resistance here in the market are saying, well, we've made this sort of high 3 times now, and it'll be hard for the market to go through this. But let's see. I mean, the the old adage, "Don't fight the Fed," is very important here. So we're in a global easing cycle, which is very important. We have low inflation everywhere. Inflation is actually coming down everywhere in Europe and the U.S. I mean, if you look at copper prices, you look even oil, which has been driven a little bit by geopolitical worries, obviously what's going on with Iran and the conflict there. Even oil prices haven't gone up that much. So if you look at inflation in general, the trend is down, which is, if you are in an environment where you're not too worried about a recession, but you can sustain about 2% growth and low inflation and low interest rates, that's actually a very good environment for stocks. So we continue to be very constructive on our stocks. That said, I think you have to be very careful about positioning. A stock that I'd like to highlight this week is Adobe. Adobe is one of our core holdings in our growth portfolios and our what we call our Bulldog portfolios, which is our growth portfolio that has dominant companies in it. Adobe is a phenomenal stock in this environment. So they just had their revenues out. Revenue growth year on year was 25%. In a macro environment of 2%, that's obviously phenomenal. If you think about what Adobe does, they're really at the forefront of what we call this digital transformation. Every time you go on a website and you see the interface or the graphics that are behind it, that's basically all Adobe. And the analytics, if you think about artificial intelligence and all that, Adobe really makes not only the visual aspects of a website, but also it allows you to gather data through their software of the user. So Adobe went through this digital transformation themselves many years ago, where they went from a contractual arrangement with their customers to an online cloud-based subscription model. So in this environment where we don't want to be allocated or dependent on cyclical type earnings, it's very interesting. The recurring revenue part of Adobe is about at 7.5 billion of their about 9.5 billion revenues. So 75% of their revenues are recurring. I mean, that's a phenomenal business if you think about it. Most tech companies, whether you're selling chips or you're in industrial companies and you're dependent on orders, the only thing you know about your future growth is either your backlog, if you're lucky enough to have that, or or other indicators. But it's nice to wake up every morning in a business like Adobe and know exactly where your revenue is going to be the next day. So that's why that company is very, very valuable. That's why it deserves a high multiple. And it's exactly the sort of thing we want to own. Another example of that, it's the second stock this week that was our best performer is also in our growth portfolios or our Bulldog portfolios is Autodesk. Autodesk is very similar to Adobe. It creates software more in the architects and contractor space. and it's also transitioning. It's still going through the transition of a contractual relationship with their clients to an online cloud-based system. But you can see it's also that kind of stock that's doing very well because they're shifting from more uncertain types of revenues to recurring. So, this is a theme that we have throughout our even our growth portfolios right now. We want to be very mindful that we're at the later stage of the business cycle and it's rolling over. So at this point, we want companies that have sustainable recurring type revenues. So on the S&P 500 front, my colleague Terry Gardner has done some very good work on the earnings side. We're watching that very closely. We're lapping very bullish earnings estimate revisions about 6-7 months ago. The year-on-year estimate revision is going to start turning negative quite soon, which doesn't mean we have negative earnings growth this year. It's just that the sales side analysts out there are really starting to pull back their expectations on earnings growth in the future. So Terry does a lot of work on that. It's part of his weekly that comes out. That's in written form. You may want to take a look at that quite closely. So we're still seeing earnings growth out of the general market in 2019, but for us, it's incredibly important, we think, and this is why the market is still favoring growth stocks. We think that will be with us for quite a while, given we don't believe we're going into a recession in the next year. So growth stocks that have higher degrees of revenue growth and earnings per share growth will be in favor. So that's it for me for this week. It's been a miserable week here weather-wise in New York City, and it seems like the clouds have dissipated and we finally get some sun on the weekend. So on that note, I wish you all a great weekend. Take care.